Hey there, welcome back to the channel. Today we're diving into a topic that impacts almost every financial decision you make, credit scores. Whether you're buying a car, applying for a mortgage, or just opening a new credit card, your credit score can affect a lot more than you think. So let's break it down. All right, so first off, what is a credit score? A credit score is a three-digit number that lenders use to assess how likely you are to repay debt. It's based on your credit history, basically how you've managed debt in the past. Credit scores generally range from 300 to 850. The higher your score, the better. A good score usually starts around 670, but to get the best interest rates, you'll want to aim for 740 or higher. Now let's talk about the factors that go into calculating your credit score. There are 5 main things you need to know. First, payment history. This is the most important factor, making up 35% of your score. If you're late on payments, your score could take a big hit. Pro tip, set up automatic payments or reminders so you never miss a due date. Next is amounts owed, which accounts for 30%. This includes your credit utilization ratio, basically how much credit you're using versus how much you have available. Keeping this ratio under 30% is key. Then we have length of credit history, which makes up around 15% of your score. The longer your accounts have been opened and in good standing, the better it is for your score. Number 4 is credit mix. That's around 10%. Having a mix of different types of credit, like credit cards, mortgages, and auto loans, can be a good sign to lenders. And finally, new credit, which is another around 10%. Opening too many accounts at once can be a red flag to lenders, so be cautious when applying for new credit. Okay, so you know what goes into your credit score, but why does it even matter? Your credit score can affect everything from the interest rate on a loan to whether or not you can rent an apartment. A good score can save you thousands of dollars over your lifetime, while a low score can mean higher interest rates or even being denied credit altogether. For example, let's say you and your friend both get a $20,000 loan for a car. You have a credit score of 750, so you can get an interest rate of 3%. Your friend, however, has a credit score of 600, so their rate is 9%. Over the life of the loan, you'll pay a lot less in interest compared to your friend just because of your credit score. Now that you know how important your score is, let's talk about how to improve it. Here are 3 actionable tips you can start using today. First, always pay your bills on time. Remember, payment history is the most significant factor in your score. Second, reduce your credit card balances. Try to keep your credit utilization below 30%, and if possible, aim for under 10%. And lastly, avoid opening too many new credit accounts at once. Each application triggers a hard inquiry, which can slightly lower your score. Understanding your credit score is a powerful step toward managing your finances. The key is to stay on top of your payments, keep your balances low, and avoid unnecessary credit inquiries. Trust me, your future self will thank you. All right, that's all for today. If you found this video helpful, don't forget to give it a thumbs up and hit that subscribe button for more tips on managing your money and building a strong financial future. And hey, if you have any questions about credit scores or other financial topics, drop them in the comments below. We'd love to hear from you. See you next time.